Welcome back, everybody, and hopefully you've enjoyed some good sessions so far. Certainly, I think it's good of the organisers to put all the heavy-duty regulatory stuff in the morning before lunch while we're still relatively alert and okay. Our next session is about CSDR, and it's intriguingly titled the zombie regulation, and I'm definitely looking forward to finding out which type of zombie we're talking about, whether it's that sort of flesh-eating post-1950s Hollywood version, or rather the sort of more traditional, I think, version that just is a rather lifeless, limping along living being. So we're about to find out. But anyway, I'm going to pass over now to our moderator for this session, who's Matt Johnson, who represents ITP Product Management and Industry Relations at DTCC. Matt, over to you, and I will leave you to it, and at this point drop out. Thank you.
Brilliant. Thank you so much, Kevin. So good afternoon, first and foremost. Thank you for taking the time to join us today. As Kevin mentioned, for those that don't know me, I'm Matt Johnson, part of the European Product Management and Industry Relations team at the DTCC, and I'm very pleased to be the moderator today. So over 230 years ago, Benjamin Franklin wrote, "Nothing in this world is certain except for death and taxes." However, if he were here today, I think that statement would actually say nothing in this world is certain except for death, taxes, and increased financial regulation. And like Kevin mentioned, that's exactly why we're here today. So the Central Security Depository Regulation will be the discussion point for our panel today. And that's exactly what we'll be covering for the next 40 minutes. Before we kick off, just a reminder that you can submit questions throughout the session via the CVent app. So that's enough from me. So let me introduce your panelists for today. So we have Adrian Dow, Head of Regulation and Market Practice at the International Securities Lending Association. We have Robert Frost, Global Head of Product Development for Pyram Systems, and Karan Kapoor, Head of Regulatory Solutions and Technology for Delta Capita. So thank you guys for joining. And Adrian, I need to address probably something that's on everybody's lips. So the session today has been advertised as CSDR, the zombie regulation. I mean, is CSDR really the sleeping zombie regulation, or is it understood? Are people truly prepared for it?
Thanks, Matt. Yeah, I'm slightly nervous about about volunteering for this one, but let's give it a go. I mean, Halloween was just last weekend, so I suppose it's quite topical to call it zombie at the moment. And there's plenty of articles coming out about the zombification of countries, especially in relation to the lockdown. So I suppose it's quite a topical thing. Whenever something's tough like this to answer, then you look at the definition on Google, which I did, and there's two on there, so not the ones that Kevin mentioned. So the first one, obviously, about the dead person being brought back by witchcraft. I don't think that really applies to CSDR. The better one is the tiki cocktail, which has got 3 types of rum in it: fruit juices, bitters, and Pernod. So I think that's a better analogy, perhaps. Perhaps there's a bit too much rum in it. But let's think about what's actually CSDR supposed to do. Harmonization and timing of standards across the EU. It's sort of doing that. The question then, I suppose you're asking, is about SDR, the settlement discipline regime. So that's got some pretty tough questions in it. And when you say, is it truly understood? I think that the answer is going to be no. Settlement discipline by itself shouldn't negatively impact the market. But the construction as it is at the moment is pretty much universally accepted not to be fit for purpose. So the big issues are the usual suspects that have been spoken about for a year or more now, of asymmetry of the buy-in and the cash compensation. The scope of it, should stock loans or SFTs be in scope at all? Or if they are in scope, then the open transactions, should they be in scope for the mandatory buy-in? Complexity of the pass-on mechanism to ensure the right person pays the right amount, and those penalties, who actually pays them. If it's the CSD participant who's the one who gets the penalties, then how does that get passed on to the person who might have done the trade, who isn't the actual CSD participant? And then, of course, contractual arrangements, and there are meetings going on about those actually literally constantly at the moment, about what exactly needs to be inside the contract. It's mandated for in the regulation, but what does that actually mean? There is something already in a lot of the master agreements which has a contractual remedy for a buy-in and the compensation that goes along with it. It's been around for years, but is that the thing that's the regulation is asking for? So how and what do we need to put into the agreement and do they fulfill that requirement. So I'll go back to the analogies part of it, and it occurred to me for a moment to talk about this one that might resonate with some of us, of driving a car, getting lost, not asking for directions, and carry on going, getting worse and worse. And it has that type of feel to it, but that's still not a great analogy. So I'm going to stick with the zombie cocktail. Perhaps too much rum in it, and as a consequence of that, there's a lot of confusion, and people are unclear, which is typically what happens if you drink something of that nature. I'm also reminded of a conversation that happened last year about CSDR, obviously in one of the working groups, and we were thinking about, wouldn't it have been so much better is if SFTR was in place before CSDR was implemented, because then the regulators would have had a better feel for the shape and size of the market. But of course, that only applies to SFTs, and the CSDR was looking at a larger scope than that. So if the aim is to improve settlement efficiency, then CSDR clearly is the big stick, which maybe is the right analogy to use. And the proposal that I'm hearing most of is that we should start off small, if we're going to start with penalties at all, and then sort of redress those, review them at certain stages to make sure it's doing the right thing. So not completely a zombie, but maybe a cocktail.
Interesting. Yeah, very good points, very good opinion. And Rob, over to you. So clearly Pyram are one of the most well-known service providers in the securities lending space. Is CSDR on your client's radar? And I'm presuming it is. And if it is, what are they asking of you and your firm?
Absolutely, Matt. Yeah, and it has been for some time, to be fair. And I guess what our clients have been asking us for, nearly 2 years in some cases now is, I guess, looking at this in different stages. So, the first stage is the fails identification. So do I have a good grip on where my fails are, and can I see them? So we've been working with firms to do that, given we have a lot of the data with the pre-matching service and the real-time contract compare, etc. So we've been working on that as a first phase. I think then it's a case of understanding, well, what's causing that fail? And in a lot of cases, using the comparison of the pre-matching tools can help identify that. I think the third phase is to then, where you've got those, you've identified the causes of those fails. Well, are there tools that already exist where we can be utilising them better or more to actually prevent those fails in the first place? So automation is a key one, and we've seen, a big drive to automation, and not just SFTR driven or CSDR driven, but even prior to these regulations really coming to the fore. So I think that's been the third stage of the journey. And then the next stage is to then, post that root cause analysis, and where we don't have a solution maybe is what else do we need to look at from a product development perspective, which is why obviously I've been heavily involved from a Pyram perspective. So I think the engagement's been really good from the market. We've been involved in all of the industry working groups, and they've been very, very well attended, in my opinion. There's been lots of, good conversation. And again, I think what I've been pleased with is the approach to this, in terms of, Adrian mentioned about the fallout of the fines and the buy-ins and how are we going to handle that, whereas it's been positive from my perspective to see the industry engaging, well, how do we prevent the fouls we do have, looking at the existing processes where there are good processes that prevent the fouls and the mismatches in the first place, looking to extend those and then iron out the remaining problems. So I think it's been a positive approach from what I've seen from the industry. And then I think there's been other challenges that firms have seen in terms of some systems having contractual settlement, for example, rather than an actual settlement. So that's really difficult to then see your fouls in your own books and records. So we've had a lot of engagement around firms that are looking to, maybe change that or work with us to improve that as well. And that's really important to get ahead of that, because that's not necessarily something you can easily do. And then another big thing is SSIs. We've had the ability to compare SSIs for many years. For whatever reason, that hasn't been the standard. But I know certainly with the ISLA working groups has been talk about putting best practice around that, or more best practice. And we've seen a huge engagement across the industry in terms of making sure that SSIs can be compared, within minutes of the trade being booked, so that gives the pre-matching teams, a better chance of ironing out any issues on trade date, so that when you get to settlement date, you don't have the foul, you've got much less chance of having the foul. So I think it's been really, really positive, and they're really the main things that the clients have been engaged with us at Pyram on.
That's good to hear. Yeah, lots of very, very key points there as well. And Karen, just coming to you. So in the conversations you have with your client community, I mean, do you see clients embracing technology and automation as a way to help them navigate the challenges that CSDR may bring?
Yeah, absolutely. Matt, thanks. I think this is a very timely question at this point, because with the delay just being announced and now being confirmed, to be honest, from the time the delay was actually announced, we started having conversations with clients, and we started seeing that there was a shift from the usual, the minimum requirements of CSDR, whether it was cash penalties management, buy-ins management, and people had started thinking of more with the new. Is it possible with the extra time? Can we start looking at things that would help us actually resolve the root causes of issues that would cause us the most CSDR pain, for example? And most of that has been around the operational efficiency, settlement efficiency improvement kind of domain. And obviously, since Delta Capita, I've joined Delta Capita, we know that we've got loads of like in-house tech assets as well as a large partner ecosystem. So I've been fortunate enough to have those a wide variety of conversations with the clients. So the types of conversation we've continuously had with our clients around the topic is lots of clever tech that could help achieve the objective of settlement efficiency improvement, whether it is through achieving the end-to-end trade lifecycle transparency and control. As Rob mentioned, how do you identify and remediate settlement exceptions faster, understand alerts where SSIs are broken, and also lots of like intelligent workflow tools that could either help with managing, automating parts of the process through either RPA technologies or collaborative platforms. So all of those conversations have suddenly seen an uptake in the market, for us at least, which we think is steps in the right direction. But coming back to your question around the embracing of the technology, I think it's a little bit 50-50 at this point of time. So from what I know of the market, and I've been kind of following CSDR for the past 24 months, most clients are now in a position where they're going to be using technology for the minimum requirements. So everybody knows what they're doing for penalty accumulation. They've got some form of tech support, buy-ins, basic dashboards, etc. But when it comes to a bit more sophisticated automation solutions or more clever kind of technologies that can boost the settlement efficiency even further, the conversations are ongoing. Clients get very excited about talking about these topics, but again, I think it needs a little bit more of a driver. So as Adrian mentioned, CSDR might be that stick. It's quite an exciting space, to be honest. The conversations are happening, and we're all moving forward. So it's just wait and watch at this point of time.
Yeah, I think the technology piece is key. So Adrian, if you don't mind sticking to the technology angle at the moment. So from the working groups that your trade association manages and works with, I mean, is technology seen as the answer to some of these CSDR challenges?
So it's going to be a little bit around the houses sort of answer. So let's start with the work that we've been doing. So through 2019, we were holding working groups, obviously. We published 2 papers that were focused on settlement efficiency, and picks up some of the points that both Karen and Rob just been speaking about. To get the first paper out, it was actually driven by a survey that was completed in 2018, and it had some interesting things in there when it was asking market participants about their pre-matching rates, which they said were at the time in between 50 and 80%, roughly. About 25% of the people that responded weren't sure if pre-matching would help settlement. I think that number would mostly go up if we were to ask the question again now. The big issues, what did people think the big issues were that stopped pre-matching? And it was manual processes and lack of standardization. Those themes, they're repeating themes through lots of the things, lots of regulations, conversations we're having. Anyway, so settlement rates were reported to be roughly about 90% on average. The higher amount were for new loans, and it was lower settlement rate for returns. And the biggest cause of those settlement failures was SSIs, again, points the guys have just been talking about. And then when people were asked about how you're going to fix those things, they said, let's do pre-matching. So we've got a sort of direction to play there, and that's from 2 years ago. So there was another question in there, another couple of questions about, okay, what do you want us to do as an association? So beef up the best practice, which we're doing, and there's a handbook on our website now, which you can search for best practices. updated constantly. It's almost weekly. There's a change to it as we go through the review process, which I think is going to, as more regulations come along, there'll be more updates to that. Use of vendor solution is scattered all the way through our best practices, but it's something they asked to have included. And of course, there was increased standardization, which again is another one of those themes. Which we're continuing with the digital projects that we have at the moment. Anyway, the second paper that came out at the end of last year had 62 different proposals on how the market could improve what it was doing to improve settlement efficiency. Top things on there were reconciliation procedures. SSIs was the second highest one. Then you had notifications and settlements. So it's a sort of general topic of auto partial and timing of communications and those sort of things. All of those have been updated in the best practice. So virtually all of the solutions had some sort of foundation or connection to technology. What's interesting though is that the technologies has actually been around for quite a while. I mean, we're not actually talking about something completely new. These are, you know, some of these tools have existed. They're being tweaked a bit for CSDR, but they already had the right intention in there. So it's not so much about is technology the answer, but is, and like Karen said, so it's about the adoption and the standardization, because it's fantastic having two different platforms that do, you know, fantastic things. If they don't talk to each other, then you have this issue of interoperability that came up with SFTR, and it carries on through settlement efficiency topics as well. So I was having a look through for this point. I was having a look through our best practice paper. 25% of best practices mention vendors in them. So it shows you that using vendors, I think, as a way of gluing together counterparts is something that that many are asking for, because best practices are driven by members. And there's another theme in it, and it's aspirational. We're asking in best practices to be something a little bit more than we are at the moment. And if they were going to be completely aspirational about it, it would be that at the point the trade's booked, it would at that point tell someone this isn't going to settle because of such and such a reason. To get to that point, there needs to be a very, very wide adoption and standardization of technology to be able to fix that. And of course, the nice side effect of that, of course, is you get settlement efficiency, which helps with CSDR. So we are addressing all those things in best practices, in digitalization, and through the working groups we've got. Sorry, that was a bit of a long one.
No, the floor is yours. It's totally fine. And I just wanted to touch on, like you mentioned, best practices, guidelines, and so on. So I wanted to come to Rob, and obviously Rob's been involved with SFTR as well as being well involved in CSDR as well. So in your opinion, Rob, has regulation helped drive better client behaviour in post-trade processes, or do we still see too many manual processes still going on?
It has, absolutely, as you would expect. I don't think there's any surprises there. You know, we shouldn't forget there were people that were adopting, a lot of firms adopting automation before the regulations, as I mentioned earlier. But I think to Adrian's point in terms of the adoption, you know, I think this was evident during the COVID pandemic, particularly through March and April, with, you know, increased volumes and the working from home, whereby I think it was evident in a lot of cases that there wasn't enough adoption of that automation that exists today, because people were struggling with manual processes and not having the people in place or with the right home access, for example, to carry out and maintain the levels of increased volume. So I think there definitely has been more adoption. There needs to be more across the industry. And I think we've definitely seen that, you know, this in the last 12, 18 months, you know, a lot more adoption of the automation of our post-trade services. Some of them have seen significant increases in usage and volumes going through. And that's reassuring to see, you know, the amount of transactions or post-trade lifecycle events we see going through that are not touched by a human being every single day, you know, hundreds and hundreds of thousands. So that's great to see, but there's more to do. And again, I think the adoption point is key that Adrian made, as I said, because, you know, having more adoption across the industry will create that standardization in itself. So I think absolutely there's more to do, but we've definitely seen increased take up.
Yeah, good. I mean, I think what I wanted to do now is ask a question to all three of you. And I guess it takes into account everything that's been said at the moment. And I think it was Adrian that mentioned, first of all, we know there's a delay. Sorry, it was Karen that mentioned, we know the delay to the settlement discipline regime. It's formalised now. So how can clients use this additional time in the most effective manner? And I'll let you decide who goes first. Actually, no, I will go first. I want to go to Rob first, and then maybe to Adrian, and then to Karen.
Sure. So I think I touched upon some of it earlier in my first answer to the first question, but I think, you know, definitely participate in the industry association working groups. You know, you can learn a lot from there. As Adrian mentioned, you know, ISLA were running them in 2019. There's not only just learning about, you know, changes in the regulation and the actual rules, but also what other firms are thinking and what other challenges that people are seeing, because, you know, in a lot of cases, there's going to be a lot of overlap. I think, you know, engaging vendors and internal stakeholders, making sure you've got the right, you know, team together internally, and that you're engaging the right vendors, as we've touched upon. I think looking at that target operating model, you know, Adrian mentioned about the pre-matching and seeing the breaks within, you know, minutes of the trade being booked. There's technology that already, you know, allows for that. So look at that operating model. Is that something we want across all of our book? How much of our book are we doing that for example? And I think, you know, other things I mentioned, you know, making sure you've got visibility of those fails in real time. That's absolutely key, because if you're going to prevent them, you need to be able to see them and do that root cause analysis that I mentioned. And I think, you know, making sure there's operational resilience through the automation, you know, particularly like I mentioned with COVID, making sure that not just for increased volumes, but across all of what we're doing today, making sure it's as efficient as possible. So I think the 1 year delay isn't a lot of time. It might seem like it now, but there's potentially a lot to do. So I think, you know, getting that engagement now is absolutely critical.
So me next, yes.
You next.
So back to your point, actually, because it's not official. So I mean, the Commission have proposed it, and so there's a 3-month objection period at the moment. So, but it's a bit of a formality. In terms of how to use the time, I think that people should already know what the answer to this is. To some degree, it sort of doesn't really matter. Like I said, to some degree, it doesn't matter how much the regulation. Is it going to stay the same? Is it going to change into something else? Because there's still this root problem that needs to be solved about settlement efficiency, which even in the current form is using up resource perhaps it shouldn't. So we know what causes the settlement failures. There's loads of papers written about it, not least the ones that we've put out there as well. And of course, vendors, consultants, and many others have got you know, can help with fixing those things. So spending the time fixing the issues that are a priority for you. So because you know, people have different issues. I mean, the one that Rob mentioned about some systems not being able to track whether something's settled or not, that's actually quite a key thing, isn't it? If you're trying to track something for settlement failure. The looming reg as well should be an incentive to release budget, I'm hoping, so that people can do the development to upgrade their systems in time for when this does go live. There clearly is going to be some sort of settlement discipline regime that we hope isn't going to be as bad as the one that is at the moment. But if it was just to be penalties, and even if they were small, then there's a cost associated with that. And so to offset it, release the budget now, do the developments. The other thing, great point, Rob, about working groups, not just CSDR groups. Actually, there's a whole variety of working groups that ISLA have got now. You can find them on the website, and they're very easy to join in. But obviously, things like the best practice or collateral. I mean, there's the whole variety of areas that you should be looking at to fix, because all of those things coming together create settlement efficiency. And basically, as a sort of summary answer, get your house in order because you know what's around the corner. The zombies, right? So.
And Karen, just your opinions on how people use
yeah,
time.
Thanks, Matt. So obviously, I cannot disagree with anything that Rob and Adrian said. I mean, everybody knows the answer, right? This delay is not something that you can use to take your foot off the accelerator. We all know that the work needs to be done. If it's not done today, it has to be done tomorrow. So might as well get started. But what I definitely think is that I'll start with a story. So I was working when I was about 18 months ago, we were working at a tier 1 client trying to define the plan for the CSDR delivery. And lots of ideas came up to the surface. We were talking about doing strategic initiatives, balancing that with some tactical fixes where everything had to go in parallel. But as the time passed, as it always happens, pressures surmount, resource constraints become more apparent. The strategic initiatives kind of fade away, and we kind of focus on tactical initiatives. I think it's time to bring back those conversations again, trying to look at how you can actually use CSDR as a driver to kind of push forward more strategic initiatives, whether it's operational efficiency, cost, etc. One of the clients that I used to work for told me that no good reg should go waste, and it all should be used to kind of push forward some strategic initiative of the other. So CSDR is a pretty perfect example for that, because zombies are coming. We need to be prepared, so we need to push forward. I think, as Adrian and Rob already mentioned, CSDR has given rise to a lot of innovation in the fintech landscape. Existing tools have been tweaked to kind of be more effective for CSDR. I mean, Delta Capita have a virtual booth at 240 as well, talking about some of our solutions around DC Echo. So this is a good time to go shopping. People should go out and see what's out there, look at the vendors, understand what's going on, and see what's best fitting for them. And starting to embrace the new technologies and adopting that will only be good in the long run.
And just staying with you, Karen, for a second. So in your view and what you've seen and what you've heard, who do you think is going to be most impacted by the upcoming and the actual settlement discipline regime itself?
Yeah, that's a very interesting question, Matt. So I think it's a common rabbit hole that many of our clients that we speak to kind of tend to go down into. So they always kind of say the sell side and the CSDs are most impacted by CSDR. So anybody who isn't part of those types of market participants don't need to react as much. But I don't think that's the case, because if you are in the securities trading life cycle and value chain, you are going to be impacted. The question is how the impact is going to be, what the impact is going to be, and how are you going to best assess it and manage it. So there's no way that you can escape the CSDR impact. You just need to be able to assess it and put your best foot forward. So sell-side firms, obviously, I mean, everybody knows, are going to be impacted the most, and they are aware of it, and things are happening, and they are working on it. But at the same time, buy-side firms, for example, securities lending firms, custody, market infrastructure providers, all will be impacted. And every single participant needs to do due diligence to understand what that impact is and manage it properly. For instance, like buy-side firms, if they don't improve their settlement behavior today, they will risk reputational damage in the long run. As the market improves, they don't. It's not going to be ideal. Similarly, custody clients that we've spoken to, prime brokerage firms, have started receiving heightened client expectations around, helping them manage the burden of CSDR better. So there is obviously that kind of like market differentiation that's going to start happening based on CSDR. So everybody needs to kind of understand how to best react to this. Also, I think some of my clients within the custody and prime brokerage space, they've started looking at some services that they can offer to their clients, which are value add, which would help them better manage CSDR burdens, whether it's with more frequent MI, other kinds of services, obviously for a cost. So these are some hidden revenue channels that cannot be ignored, and it'd be great for the market to look at that and see how best to kind of take advantage of that and using the driver of CSDR. So I think just to summarize, if you're in the securities trading value chain, you will be impacted by CSDR. It is only wise that you understand fully what that impact is and then plan your delivery accordingly. Just saying that we might not be impacted or we are less impacted probably isn't the most optimal approach.
Thanks, Karen. What about you, though, Rob? I mean, from your view, do you agree with Karen's opinion and views there, or do you think there will be a specific sector that will be impacted more than most?
No, I agree with Karen. I think the key thing here is it's anyone trading in these European markets, right, are going to be impacted to some extent. And I think the key difference that I've seen with CSDR to other regulations like SFTR, for example, is, and I think this is resonating in the front office in particular, certainly from conversations that I'm having, is day one, anything that fails, there's a penalty. You know, unlike as we understand with the reporting regimes, you know, if you miss a report or your report's late, you know, chances are you're not going to get a fine or reprimanded for that. But here, one trade fails, and if it's a large trade, it is going to be a huge penalty. So there's an impact day one for any foul, and that's going to, you know, that's going to hit the P&L and the costs significantly potentially. So I think that's why we've seen so much engagement. And like I say, it's absolutely critical for this regulation in particular, you know, where that pre-matching and the settlements were just a back office or middle office function before, that's going to be so important to the front office and business heads and senior management to have visibility and control over something that's going to potentially fail, for example, or where we've got root cause problems. So I think whilst we're talking about a lot of automation, we mustn't forget the oversight. And it's all very well automating things, but even then you may get exceptions, even if your automation is very good. So making sure you've got controls and exception processes to handle those swiftly, because otherwise there is that penalty. You know, one day of failing, you're going to get hit with a fine.
What I've heard quite a lot throughout the conversation so far is the word change. And obviously, Adrian, we know we've got the European Commission's public consultation on CSDR itself, probably being published imminently. So with regards to change, I mean, what responses can we expect to this outreach? And, you know, can we see anything change in regards to the settlement discipline regime?
I mean, I don't have a crystal ball on this, absolutely. It's a long haul. I think actually, Rob, you mentioned that earlier on. So yes, there's a consultation that's coming out any day now, I hope. It's the word imminent has been used actually for about a month now, hasn't it? So I don't know, maybe I should be looking that up on Google as well. I mean, originally, some people thought that that this next imminent consultation was happening because of COVID and CSD developments and Brexit having an impact on it. I mean, certainly the studies that were done by some trade associations showed to the Commission that there's an issue with trying to implement what they've got in place at the moment if you had a scenario like COVID, which obviously for us is going to go on for quite a while. Anyway, so this consultation needs to end by the end of this year. And then the Commission is going to report to the Parliament and the Council and reflect on the outcome of that consultation. Then the member states and ESMA get involved, and there's a whole sort of process you have to go through. That makes me a little bit nervous when you think about the timing, especially if there's going to be any sort of repapering of how long that bureaucratic process takes to get to a conclusion and then change a regulation, which then could have a knock-on effect to master agreements, and doing the repapering takes many months to do. So I'm a bit nervous about that. So I don't know that we can necessarily say what the responses are going to be. We have to look at this consultation and then get a feel for, okay, what direction are they going in? There are certainly going to be targeted responses, and I hate doing it, but I'll do the quote marks. They're going to be targeted changes. I just hope that they're going to be the right ones. What's very important to us is that there is consensus. It really doesn't help if we don't have consensus, and I'm talking about across trade associations and across market members. If we don't have a consensus in the way that we respond to this next one, it throws confusion into the mix, and it doesn't help. It waters down the message. So we can't have anything like that. And so that we don't, the associations are obviously talking, and with our members as well, to make sure that we're broadly aligned in what we're asking for, and we're not going to trip anything up. The other thing that's really important is that when we respond to this next consultation, we have to quantify our arguments. If we don't quantify them, then they basically don't exist. And I know we've heard some very good quotes on that one, which is why it needs to be stressed. So we know there's targeted amendments, and it's safe to say there's going to be a discipline at the end. And I don't think that we can say much more than that at this point.
Yeah, no, that's yeah, very on point. And I would like to stress as well, I completely echo your comments. For me personally, I think the trade associations have done a fantastic job. Obviously, it's like AFME, ICMA, Investment Association, IZITSI, and so on. I think they've done a fantastic job in rounding up members and improving education and making sure that the message is directed in the correct and appropriate manner. I wanted to change direction just slightly. I've got one eye at a time, and we have had some questions in, so I would like to definitely address as many of those as I can at the end. But changing tack, just going back to Karen and Rob, I'm going to give you, what's the time? We've got about 5 minutes left, so I'm going to give you 30 seconds each. If there was one thing you could change to the current post-trade life cycle or current post-trade process, what change would you make? I'll go with Rob first, if I may.
Tough one in 30 seconds. If I can only choose one, I mean, I think it would be to automate every process that you can. Again, common theme of what I've mentioned previously today. But I think the key point I just made in the previous answer is still retain that control and oversight and make sure you've got the tools to do that, because I think that's going to be key as well.
Karen, over to you.
And just to add to that, I think, I completely agree with Rob. One of the personal things that kind of was the biggest pain for me was the disjointed data across the entire post-trade landscape of the systems. I mean, I've spent months doing analysis at various clients, trying to conduct an data analysis from the front to the back, trying to make sense of where things fail, where things don't, and trying to trace that, trace the failure of the root causes back from the settlement messages. It just completely gets lost. It's like, it's a nightmare to kind of put all of that together. So, I mean, if I would change one thing is try to find something that could help me put this big, disjointed data picture in one logical way, so we can actually understand what's going on across the post-trade lifecycle. And as we already mentioned before, get more proactive with like resolving exceptions, because at the moment the problem is we don't know where everything is, so it's very difficult to actually address it. So that is one thing that I would like to change. Just get the data in a better format. Again.
Yeah. Matt, can I just add a quick? I'll try and keep it below 30 seconds. So standardization in practices, technology, and in approach to regulation is the absolute key thing. I'm going to do a shameless plug actually for just after this session. There's an ISLA breakout session, and we're going to talk about our digital transformations, which include a common domain, which is all about standardization. And I really do think that that's something that's going to be key if we're going to try and standardize, and especially to address the point that Karen just raised, which is a very well made one. To address that, to get standardization, you need to have something like a common domain. Sorry, shameless plug.
No problem at all. No problem at all. And we've got a few minutes left, so I would like to approach some of the questions we have received. I'm not too sure who I'll directly, so I think I'll leave it open and you guys can decide who would like to answer. We've had a couple on partials and partial settlement, and I'll combine these into one question. So I think one of them is more, will partials cause further complexity to the settlements world? And also, if partials are adopted, what kind of testing is going to be needed and what sort of coordination is going to be needed to test that?
I'm happy to take that from a Pyram perspective, because we have had some engagement, not a huge amount on this, but there definitely will be technical challenges. I think that and these have been discussed in the user groups, there are challenges with the actual settlement itself, and how, particularly on an omnibus type trade for an agent lender, how you then obviously apportion that out. But certainly from a system perspective, a lot of the systems that we interact with, wouldn't necessarily handle partials very well, and will need some work to be able to handle the partial. But there's also, considerations around SFTR. So if you've got a new loan, for example, on a principal loan going out and you partial it, you need to make sure that that still stays as one UTI. And again, the way a lot of systems are structured, that would, if you split that trade, it would naturally take on two UTI. So there's a lot of things to think about. I think partialing as a concept is a good idea, and I think most people would agree with that. But there are technical challenges in implementation. We just naturally with how systems reflect settlement.
And I think we've probably got time for one last question before I hand over to Kevin. So maybe Adrian, Karen can give a quick answer on this one. So settlement rates are currently around 90% now. How much improvement would we need to see for the regulator or the market to call CSDR a success?
I'm going to say, well, actually, one of the things we were talking about just before we started this call, that actually getting settlement rates from 90 to 100% is a bit like, the analogy would be the speed of light. I mean, it takes an enormous amount of effort to get it. If we say it's at 90% at the moment, and it could be a bit higher than that, to get from 90 to 95, 97%, I think is within grasp with the technologies we have, with the plans that we're making. To get to 100%, I don't know that you'll necessarily do that, because there are a lot of different moving parts, and especially and hark back to the complexity of partials. if you consider that for a stock loan to happen in the first place, it has to come from, through a chain of different instructions, and to make all those things align is a complex thing. If you introduce auto partialling into that, all of a sudden you break that chain of instructions, and I'm talking about specifically agent lenders then as a good example, and how the assets might move from one custodian through a custodial network to actually get direct to the final borrower. Those type of things are really tough nuts to crack. So I think that we could get to 97, 98%, something like that.
And just bearing in mind the time, and I've just seen Kevin pop up on my screen, so alas, we are at the end. So first and foremost for me, I would love to thank the audience for your time today. Also, thank you to my panelists. It's been some really engaging conversation. I've actually learned quite a lot today. And for the audience, again, please enjoy the virtual networking break that's coming up, and enjoy the rest of the symposium today.